Now we are calculating our section A for FM pre-mock 2025. It is issued by ACCA. We converted it into PDF format. In relation to irredeemable security paying a fixed rate of interest, which of the following statements is correct? Irredeemable security is the one which is issued by the company, but company will not buy back from the uh, security holder. As risk rises, market value of the security will rise to ensure that investors receive an increased yield. As market rises, market value of the security will not rise, it will fall. Market value of irredeemable loan note is calculated by multiplying the interest by the 1 minus tax rate and then divided by the yield of a loan note. This is the formula. Market value is equal to interest. Interest is determined in the dollar value and no taxation will be deducted over here and divided by cost of debt, which is like cost of debt after tax. It is also called market interest rate or effective rate of interest. So there will be no deduction of the taxation. Irredeemable loan notes are a tax efficient way of raising finance. Yes, it is a tax efficient way of raising finance. So, correct answer is only the third one. Next one is second question. C company is an all equity financed company considering appraising a project in a new area of a business. Whenever you want to invest in the new area, it is called diversification. Its existing equity beta is 1.3. Equity beta of C company, a company in the new business area is 1.5. A debt divided by debt plus equity ratio is 35%, which means debt to equity ratio is, debt to capital employed ratio is 35%. Risk-free rate of return is 4% and market risk premium is 5%. Market risk premium is the difference between market return and risk-free return. It means risk-free return has already been deducted. Ignore taxation and using the CAPM, what is the risk-adjusted cost of equity? So now we are expected to calculate risk-adjusted cost of equity. Risk-adjusted cost of equity can be determined by using three steps. Step number one is beta asset. Beta asset is also called ungeared beta. Now we will use the competitor information where new business has like debt to equity ratio of 35. So, and their debt plus equity ratio is the denominator. Debt plus equity is denominator and they have what? They have debt proportion of 35%. So what can we say that what we have like as debt or as the equity proportion? So we can say that like in this case, value of debt will be considered like 35% and value of equity will be considered as 65%. So beta asset is equal to proportion of equity, which is 0.65 divided by proportion of equity plus proportion of debt into 1 minus tax, but taxation is not given here, multiplied by beta equity of the competitor. So we will solve this. 0.65 divided by 1 multiplied by 1.5. So we have 0.975. Step number 2, beta equity is the proportion of debt. Now what is the proportion of debt? Proportion of debt is like of our company. And we also need the proportion of equity. This company is 100% equity finance So the proportion of debt is 0 plus equity finance is 100% or 1 divided by the equity, it is 1. Why did I if put all these figures? Because always you will not get the same 100% equity finance. So this is the formula. Remember, proportion of debt into 1 minus tax plus proportion of equity divided by proportion of equity and multiplied by beta asset which we determine. So here we have 1 divided by 1. So the answer will be 1 and beta equity is 0.975. So one more thing you are going to learn that beta asset is equal to beta equity when if a company is 100% equity finance. If a company is 100% equity finance, then beta asset is equal to beta equity. Step 3 is cost of equity minus is equal to risk-free rate plus market risk premium multiplied by 0.975. So we can calculate it is 5 multiplied by 0.975 plus 4, 8.875. 8.875%. Nearest is 8.9%. The following are extract from the financial statement of Simply Company: revenue, cost of sales, inventories, trade receivables, 85% sales are on credit, trade payables, purchases for the year totaled $1.251 million. Assume a 360-day year. Calculate simply inventory holding period, trade receivables collection period, and trade payables payment period. Okay. So first we will calculate our credit sales, which is 3560 multiplied by 0.85. 3026 million. Now we can calculate receivable days is equal to receivables 455 divided by 3026 multiplied by 360. So we have 54.13 days. We have 54 days. Now we will calculate payables days is equal to, we have 220 divided by cost of sales of 2150 multiplied by 360. It is 36.83 days. Then we have inventories 345 inventory days divided by 2150 multiplied by 360. It is 57.76 days, almost 58 days. So inventory holding period, this one is correct. Payables days are 37. But in front of payables, we have like 54 and 98 9 days. We will correct our payables days because purchases are given 1251. I mistakenly used cost of sales. I thought purchases are not provided. So 1251. We need to correct this answer. 220 divided by 1251 into 360. It is 63 days. So this is the right answer, payables days. Now, in parallel to receivable days, we have payables, and in parallel to payables days, we have receivables. Either it is mistake in the original practice platform, or when we downloaded in the PDF form or converted into PDF form, it is possible that. So we can say that this block is relevant with receivables, and this block is relevant with payables. So the 63 days are relevant over here, and for receivables 54 days. This one is the right answer of question number 3. Now we have question number 4. Which of the following statements is true? The sensitivity of NPV to a change in sales volume can be calculated as NPV divided by present value of future sales contribution after tax. It is true. Whenever you want to calculate sensitivity percentage is equal to net present value divided by relevant item present value after tax. Now, relevant item means what? Relevant item means if you are calculating percentage change in the sales volume, you will say net present value divided by present value of sales revenue, present value of sales contribution after tax. If you are calculating percentage change in selling price, then you will say net present value is divided by present value of sales revenue after tax. If we say percentage change in variable cost, then we will say net present value divided by present value of variable cost after tax. If we are calculating sensitivity percentage of fixed cost, then net present value divided by present value of fixed cost after tax. Now the second technical point which we need to determine, if we are which we need to learn, if we are going to calculate sensitivity percentage in a 20 marks question of investment appraisal, then tax does not mean the taxation which we determine during the calculation of net present value. Suppose here if we are calculating revenue or present value of revenue, now we will calculate tax on revenue. Similarly, if we are calculating present value of variable cost, now we will calculate tax saving on variable cost. If we are calculating present value of fixed cost, then tax saving on the fixed cost. Similarly, percentage of sales volume requires uh, sales contribution. Now we will calculate tax payment on the sales contribution. So whatever present value item you determining or calculating, you will calculate tax on that particular working. So this one is the correct answer, correct statement. Problem with the risk and uncertainty in investment appraisal is that neither can be quantified or measured. This is true for the uncertainty, but not true for the risk. So this statement is incorrect. The lower the sensitivity margin, the less critical the variable is to the NPV decision. This is not true. The lower the sensitivity margin, the less critical. Suppose if sales volume has a sensitivity analysis of 3%, it is critical. If sales price has a sensitivity of 2.5%, it is critical. But if we say that similarly, variable cost will by change by 3%, it can lead our net present value to zero. It is critical. So apparently it looks also incorrect. Only the statement number 1 looks the correct option. Which of the following is an illustration of principal agent problem? Now, what is this principal agent relationship? It is basically agency theory. Agency theory says what? Agency theory says we have a principal who is called shareholder and investor. We have agent who is called management of the company. Now, management of the company is managing the business on behalf of the principal or agent or shareholders. Management of the company or agent is responsible to protect the interest of principal or uh, shareholders or finance providers. So suppliers cutting their cost by using cheaper material to keep their prices low. This is not the principal agent problem. Principal agent problem arises when managers are putting their personal interest first in comparison with the finance providers' interest or shareholder interest. Managers avoiding debt finance because lower interest payment avoids the need for careful cash management. Careful cash management means what? We need to have sufficient cash whenever we are expected to settle the liability or expected to settle the loan. Second thing is when we have lower interest payment, definitely tax benefit will be low. So it will not give any significant change in the weighted average cost of capital. Shareholders group disagreeing over dividend policy. This is not the principal agent problem. And the next one is stock market exerting pressure on companies to achieve short-term profits. Stock market usually do not put any kind of pressure, so it is also not the correct. Correct option is this one, where managers are avoiding into debt finance because lower interest payment avoids the need for careful cash management. And when we have low interest payment, we know that we will be able to settle if we are managing our cash on a regular basis or daily basis. No significant cash adjustment or management is needed. A machine costing 225,000 has a useful life of 4 years, at the end of which time estimated present value of the resale is 15,300. Present value of the total running cost over the next 4 years is 55,567. Cost of capital is 10%. What is the equivalent cost of using the machine if it were bought and replaced every 4 years in perpetuity? So first we need to do what? First we need to determine our net present value. And what is the net present value? Net present value is we are expecting cash inflow present value 15,300 minus machine costing 225,000 minus running cost present value 55,567. So NPV is what? We can calculate net present value 15,300 minus 225,000 minus 55,567. So we have what? Negative 265, 267. This is the net present value. Now we need to determine what? We need to calculate our equivalent annual cost. Equivalent annual cost means what? Equivalent annual cost can be called average cost per year, where net present value is divided by annuity factor at given cost of capital for given years. 10% of is the cost of capital, 4 years is the useful life, and annuity factor for this time for 4 years is 3.170. So divided by 3.170. So we will calculate equivalent annual cost 83,680. So 265, 267 divided by 3.17. This is the equivalent annual cost and shown in bracket. Now we have Colonial Company has 75 million equity shares in issue and has yet just reported a profit after tax of 35 million. A new issue of 25 million equity shares at an issue price of 1.2 being considered. All proceeds would be to use to redeem a bank loan with an annual cost of 5%. Colonial Company pays corporation tax rate of 25%, assuming that operating profit remains constant. If equity issue goes ahead and the bank loan is redeemed, what will be the new earnings per share? Okay, so right now we have what? We have profit after tax of 35 million. 35 million is the profit after tax. Plus what? We are going to issue 25 million shares at a price of 1.20. And we have a tax rate of what? We have a tax rate of 25%, and bank loan is what? Bank loan is 5%. So we can calculate that 25 million shares at 1.20, 25 multiplied by 1.2. Probably it will be 30 billion. It is 30 million. These all proceeds are used to redeem the loan. So we are going to redeem the loan. It means we are going to reduce our interest expense. So interest on this redemption of loan is 5%. And definitely when we are going to redeem our loan, we are going to reduce our interest expense and there will be loss of tax benefit on interest. So 30 into 0.05 multiplied by 0.75. So 1.125 million is the interest. So 35 plus 1.125 is $36.125 million. This is the profit after tax. Previously we have 75 million shares. Now we have additional 25. So EPS is equal to 36.125 divided by 75 million shares plus 25. So total we have 100 million. So the answer will be 0.36125 earnings per share. This is the right answer. Which two of the following descriptions are not main macroeconomic policy objectives? Macroeconomic is basically dealing with the whole economy, ensuring minimum amount of price increases, increasing national income and living standards, ensuring a balanced ratio of import or export, maintaining interest at the minimum interest level. This is the objective of macroeconomic, and balancing payment spending with the tax receipts. This is the objective of the macroeconomic to avoid any budget surplus or especially budget deficits. Rest are not the objectives, sorry, these are not the objectives of macroeconomic. These are the objectives of fiscal or micro. Rest are called what? Rest are called the macroeconomic policy objective, where we are doing what? We are maintaining like minimum amount of price increases, national income increase, like balanced ratio of import or export, and stable and fully employed labor force. Next is BIHA is a listed company seeking a new source of finance to fund a long-term investment project. Director have been advised that Islamic finance is alternative source of conventional finance. Which of the following statements are correct in relation to Islamic finance? Islamic finance is basically the one which is focusing on riba free or interest free. Islamic finance also put stress that there must not be any like fixed rate of interest on loan or investment. All everything this must be distributed on profit and loss basis. It also suggests that there must not be any investment in illegal activities or those businesses which are not considered halal or legal in the Islamic definition. Which of the following are correct in relation to Islamic finance? Mudarba is a form of equity finance where profits are shared according to pre-agreed contract and losses solely attributable to the provider of the capital. Number two, Musharka is a form of equity finance in which investment partners receive dividend and losses are shared according to capital contribution. Sukuk cannot bear interest. Sukuk holders return for providing finance is a share of income generated by bonds. Islamic instruments by their nature mean they are not traded through a secondary market. First one is correct. It is like a business angel where the finance provider is providing the finance and the other person who has skill will use his or her skill to run the business. But if there will be losses, the loss is only borne by the capital provider. And sukuks are called Islamic bonds. They don't have fixed rate of interest. They are traded in the market, but their interest rate is variable and it all depends on the actual profit or loss. Rest of the two are not the correct statements. So 1 and 3 are the right answers. A large listed company issued 90-day commercial paper with a nominal value of $5 million. Nominal value means book value. Each paper will have a nominal value of 10,000. So we can calculate number of papers by dividing 5 million with $10,000. Annual required rate of return is 6%, which can be considered as cost of debt or effective rate of interest or market interest rate. Assuming 30-day period, what will be the issue price of each paper? So what will be the issue price? We know that par value is 10,000. Our interest is 6%, but we are not going to issue for a year. We are going to issue for 90 days. So we will calculate interest percentage first. We will portion this interest percentage on 90 days. 1 plus interest into 90 divided by 360. So 90 divided by 360 multiplied by 0.06 plus 1. We have 1.01. Now we can calculate issue price, which is equal to $10,000 divided by 1.015. So $10,000, it is 9852. Financial extract from Salvo company, revenue before profit before interest and tax. Then we have profit after tax, we have dividend and 8% loan notes. Requirement of the question is what is the Slavo company's interest cover? So interest cover requires profit before interest and tax. Interest expense is not provided here. but we can calculate interest expense on loan note is equal to 3525 multiplied by 8%. So we have what? 3525 into 0.08, it is 282,000 we have in 100,000. So interest cover 2650 divided by 282, we have 9 point approximately 4 times. So 9.4 times is the right answer. Next one is bar company set an inventory ordering quantity of 100,000 units. This is order size. If it is determined with the formula of EOQ, we can say that it is EOQ, or the third word is reorder quantity. So the meaning of all four words is same over here. Cost of placing and processing order is $200. And what is the cost of holding is 0.25 per unit per year. Remember, holding cost is always needed on per unit per year. If it is not given on the per unit per year basis, if it is given on per unit per month, per unit per quarter, then convert into annual holding cost per unit. Similarly, if ordering quantity or purchase demand is not provided on annual basis, if it is provided on monthly, quarterly, or 6 monthly basis, always convert it into per year. Orders are received 1 week after being placed. This is the lead time, that if we are going to place the order now, our supplier will take 1 week to deliver. And so a buffer inventory of 10,000 units is required. Buffer inventory is also called safety stock. It is also called minimum inventory, that we will maintain minimum inventory of 10,000 units. Production requirement for the next year is 600,000 units. So the next year demand is 600,000 units. What is the cost of bar company inventory ordering policy? So inventory ordering policy have two costs. First one is total holding cost, which is equal to order size divided by 2 plus buffer inventory. This divided by 2 is not applicable on the buffer inventory, multiplied by 0.5 holding cost per unit per annum. So we can calculate like $30,000. Then we have total ordering cost, annual demand, next year demand is 600,000, and order size is 100,000. Total annual demand divided by order size means number of orders. Multiplied by ordering cost per order is 200. So it will be $1,200. 6 order into 2. So the total cost is what? Total cost is 30,000 plus 1,200, $31,200. This is the right answer. Which of the following statements about an over-the-counter interest rate option are correct? Over-the-counter means customized, it tailor-made. It is going to fulfill the requirement of the customer. It is an agreement with a financial institution. It can be traded, it can not be traded. Option may or may not be exercised. Option means what? You have a choice. If at the settlement date your purchased option is in your favor, then you will exercise the option. If it is not in your favor, you will lapse the option. Premium is payable only if it is exercised. Premium is payable when you purchase the option, either it is exercised or lapsed. So 2 and 4 are incorrect and 1 and 3 are the correct answers. Which of the following are true? An aggressive working capital investment policy implies a higher proportion of fluctuating current assets to permanent current assets. Long-term finance is generally cheaper than the short-term finance. Long-term finance is generally expensive than the short-term finance. Aggressive policy implies a higher proportion of fluctuating current assets. Aggressive policy is the one where we have lower amount of investment in working capital. So both the statements will be considered incorrect. An exchange loss of 100,000 is expected to result in consolidated accounts of a company after consolidation the result of its foreign subsidiary. What type of exchange risk would a company experience with $100,000 loss in the consolidated financial statement? Economic risk is the one which is relevant with the economic circumstances of a country. So if economic circumstances of a country are good, their currency will strengthen. If it is weak, their currency will weaken. Translation risk is the one which arises in a relationship of subsidiary and parent, where we are converting the financial statement of a subsidiary into parent currency, then there could be exchange gain or exchange loss. So this situation is relevant with the parent company or consolidation. So it is translation risk. Transaction risk is the one which is relevant with the future transaction which will be held at a predetermined date, either it is receipts or payment, and probably this receipts or payment will be in the foreign currency. So here the correct option is the translation risk. So we are done with all the first 15 MCQs of our pre-March mock 2025.